Good morning, everyone. Welcome to this week's research morning call. This week is pretty content heavy. We have quite a bit of results from the tech companies as well as the Singapore REIT. And also we have several initiation as well. And also we have our usual technical analysis, SG Weekly, SG Monthly, and macro update. So before we start, this is our usual disclaimer. So everything we shared today is solely for educational purposes. Without further ado, I'll pass my time to Glenn.
Hey, thanks, Helena. Yeah, so we'll just start off with Tesla, which released their fourth quarter and also their full year results. Next slide, please. Yeah, so the fourth quarter results, while quite disastrous and quite poor, did come in slightly above our expectations. FY25 revenue and adjusted PATMI were at 109 and 111% of our forecast, mainly driven by the higher than expected auto gross margins. The adjusted PATMI still did fall by 16% due to the decline in vehicle deliveries, lower regulatory credit revenue, and also higher OpEx from their AI and R&D projects for the robots and robotaxi and cybercab. For deliveries, it was down by 16% year-on-year, which is a record year-on-year decline from the removal of the EV tax credit. So it came in as predicted. Last quarter I did say that deliveries will decline, but I think we weren't expecting it to fall by such a large margin. Gross margins improved slightly by 3.8 percentage points year-on-year. But then if you look at their operating margin, it continued to fall because of the higher OpEx that they are spending on their AI and R&D projects. The average selling prices rose by 6%. So year-on-year, you would think that this would be a good thing, that the selling prices rose, but if you look at it, it's actually a negative because we view it as a negative because higher average selling prices means that it'll be more expensive for their customers. And we believe that this higher average selling prices really came from the removal of the EV tax credit. So it just pushed prices up immediately for all their cars by $7,500. And this will also lower demand further moving forward because it's now more expensive for customers to buy the same exact car as it was before 30th September 2025. So resultantly, we saw the auto revenue decline by 11% from this lower demand. Yeah, jumping straight to the outlook and the view. Tesla has framed 2026 as this very capital intensive strategic pivot where they're really moving, and as my title suggests, going all in on autonomous vehicles and robots. So they are going to be spending capex of in excess of $20 billion, mainly for 6 factories to produce the robots and also the robotaxi and cybercab. Yeah, so again, they did not give any specific figures for their guidance, right? But they are saying that the planned volume growth, volume production for the cybercab, robotaxi, and the Optimus robots will help to grow their business, and how they're changing from just an EV car maker to a robotics company now, I guess. Yeah, so our view is that the results for fourth quarter did not come as a surprise. We saw the decline in deliveries, partially offset a bit by the services, energy generation, and storage revenue growth. They have also continued to lose market share in China to BYD, even as China sales has continued to grow. And like I said earlier, they've gone all in on these autonomous vehicles and robotics. But the thing is that we have not seen a proof of concept for either the robots or the autonomous vehicles. If you look at the initial products that have been launched, they are still not yet commercially viable, or they are still very far actually from being commercially viable. Robotaxis all still require some form of human supervision. They have improved, I guess, from putting the supervision from the front seat now to the back seat, but it's still within a geo-fenced area and only limited, I think, to a few small areas in the US. For the robots wise, it's even worse, right? Demonstrations are quite bad. I think there were some demonstrations the robots just completely did not understand what the human was trying to tell, basic human instructions. And also, I think they were doing something halfway, like giving out water, and then they just fall over and it started malfunctioning. Right, and hence we believe that significant revenue contribution from these initiatives that they are going all in on are still quite far out, more than 5 years, and that In the near term, at least near to medium term, the revenue will still continue to decline as the demand for their EVs falls, and also, they are actually spending more money. Yep, so we do maintain a sell with a lower target price of $215. Yeah, now moving on to the next counter. Yeah, I'll be presenting on behalf of Fahmi as he's on leave for Microsoft. So for Microsoft, their second quarter revenue met our expectations, with revenue and adjusted PATMI at 50 and 51% of our forecast. Revenue grew by 17% year-on-year, driven by strong growth in Azure Cloud revenue by 40% year-on-year. And the adjusted PATMI rose by 23% year-on-year to 30.9 billion, driven by the higher operating leverage. In terms of the outlook and guidance that was given by Microsoft for third quarter, they expect their revenue will rise by 16% to 81.2 billion, driven by continued strong growth across the commercial businesses. And Azure is also projected to grow quite stable, right, as compared to the previous quarter by 37%, as they continue to prioritize supply amid demand exceeding capacity. And also to note that their commercial RPO has risen by 110% to 625 billion, and this is expected to be recognized over the next 2.5 years. In terms of our view, we are quite positive on Microsoft. We see very long-term visibility in earnings for both the cloud and AI monetization. And with their commercial RPO growth surging by 110% in the second quarter. And a lot of the remainder of their resources are now being directed towards supporting Azure capacity, which continues to grow in demand. And also, they have increased their investments into GPUs and in hiring AI professionals, which will just help to continue growing their Azure. We don't see that their CapEx spend will be solely tied to Azure cloud growth, but that investing across all layers of the stack will help to benefit their customers. And this will in turn drive sales growth and also expand their TAM through other avenues such as the Microsoft 365 Copilot, GitHub Copilot, and other first-party apps. This will help to create long-term value. So we upgrade to a buy with an unchanged target price of $540, mainly due to the recent price performance. So that's all I have. Now I'll hand it over to Ikban. Thanks.
Thanks, Glenn. I'll be presenting on the Micron's initiation. So we initiated Micron with a target price of 500. The background for Micron is that it designs and manufactures its own memory chips. So as you can see in the table at the bottom left, Micron is involved in the design of the chip, the front-end fabrication, and also last but not least, the back-end testing and packaging of memory chips itself. Micron is headquartered in the US. They have 13 manufacturing sites globally, as you can see in the map at the bottom right-hand corner. Most of their revenue comes from the US. 65% is from US, as you can see in the pie chart, and also Taiwan as well. Yeah. Next slide, please. Thanks. Yeah. So for Micron's business segment itself, their biggest growth comes from the cloud memory business unit. So CMBU. So currently for FY25 itself, it makes up about 36% of their revenue, and revenue spiked by 2.6 times year-on-year, and this is because there's a lot of demand for their high bandwidth memory chips. Their high bandwidth memory chips, version 3 enhanced HBM3E, is being designed into NVIDIA's Blackwell GPU as well as AMD's MI355 GPU. That's why it has been experiencing very strong revenue growth. As you can see at the image at the bottom left-hand corner, this is the image of the Blackwell B200. So each GPU has 8 high-band HBM3E stacks. So each stack, as you can see at the zoom-in version, is 8 chips. It's the height of 8 chips. Yeah, so each stack can transfer data at 1.2 terabytes per second, and if you multiply it by 8 and you deduct some memory loss because of the scaling effect, then each Blackwell chips has a bandwidth of about 8 terabytes per second. Yeah. In terms of their core CDBU, core data center business unit, it is more focused on mid-tier cloud as well as storage solutions, for example, NAND as well as SSD components. So at the image at the bottom right hand corner, this is the illustration of why storage solution is important for AI workloads. So in the storage cluster itself, it consists of network SSD as well as hard drives, and this helps to store what they call warm data as opposed to hot data that's being there's data being continuously run in AI workloads. So warm data means it is on standby, and anytime the high bandwidth memory or DRAM needs the data itself, they can transfer it from the network SSD itself. Yeah. So CDBU has also been experiencing high demand, and their revenue also increased 46% year on year. Yeah. Next slide, please. Yeah, so in terms of Micron's revenue itself, as you can see at the bottom left-hand corner, it is heavily influenced by the DRAM's prices. So DRAM makes up 78% of Micron's revenue, and we see strong demand visibility from hyperscalers for high bandwidth memory chips. So high bandwidth memory chips is a subset of DRAM, is included in DRAM. And most recently, Meta and Microsoft guided their 2026 capex to increase by 76% and 90% year on year, respectively, to support the growing AI demand. So we do think that because they also purchase memory chips directly from Micron, we do think that Micron will be a beneficiary of this increased capex guidance. And in terms of supply side, there's a huge shortage in terms of industry memory supply. So we do think that this will continue to drive DRAM price to increase. As you can see at the chart at the bottom right hand corner, the red color line is the DRAM price. The blue color line is the capex to sales ratio of the memory companies itself. So there's quite a negative correlation between the price and the blue color line, and this is because the blue color line sort of represents supply of memory chips. So we do think that towards the end of this year itself, we think there will be a dip in terms of capex to sales ratio. This is because Micron, ahead of Micron's Idaho fab construction in next year itself, 2027, we do think that there will be a fall in terms of their capex intensity. So for this year itself, we do still see a drop in terms of capex to sales ratio, and we do think that this will push the price of DRAM higher, which will in turn drive revenue growth for Micron. Yeah. Next slide, please. Thanks. Yeah. So in terms of competitive landscape, at the table on the left itself, this shows the specs of the high bandwidth memory chips of the three biggest memory players, Micron, SK Hynix, and Samsung. Currently, SK Hynix has the biggest market share in high bandwidth memory. But we do think that Micron's HBM4 chips, which is the latest version, we do think that they can chip away some market share from SK Hynix. This is because they have the highest bandwidth as well as the fastest speed compared to its competitors, SK Hynix and Samsung. And the chart at the bottom left-hand corner shows the revenue year-on-year growth among the three different memory companies. Currently, Samsung is the laggard among the three memory companies because previously their chips were being designed into NVIDIA's H20 chips to China. So because at the second quarter of last year itself, China banned the sale of H20 chips. That's why Samsung was affected as a result. However, going forward for the next few quarters, we do see all memory chip companies benefiting from this increase in demand from the increased capex guidance from hyperscalers. Yeah, so on the right side of the slide itself, this shows the cyclicality in terms of revenue, gross and net margins for the memory companies. For Micron itself. So as you can see, for Micron's revenue as well as gross and net margins, they will typically undergo an expansion and contraction cycle of about 7 to 9 months. And because in the latest fourth quarter 2025 itself, it experienced the lowest year-on-year revenue growth since fourth quarter of 2024 itself. So I do think that you will experience a rejuvenation in terms of revenue growth year on year. This is on a trailing 12 months basis. At the chart at the bottom right hand corner, this shows the forward price to book valuation sentiments. So as you can see, in terms of the valuation sentiments, it also goes through a cycle of about 4 to 8 quarters. Recently, the forward price to book ratio has expanded since the second quarter of last year itself to above 3 standard deviations. So currently, Micron is considered a bit on the premium side, but because this valuation has just expanded since second quarter of last year itself, so I do think that there's still more room to grow in terms of sentiments. Yeah. Next slide, please. Yeah, so in terms of Micron's balance sheet, um, in terms of operating cash flow, it increased by 106% year on year in FY25 because of a 10 times increase in PATMI itself. And this huge increase in PATMI is because of an increase in DRAM prices as well as bit growth, which means the amount of memory being shipped out by Micron. In terms of valuations wise, back to balance sheet, Micron's net gearing ratio decreased by 3.8 percentage points year on year because there's an increase in operating cash flow. So we do think that currently Micron's balance sheet is still healthy. We do think that for FY26 itself, they are able to transition to net cash because of the strong uptick of PATMI itself. Yeah, so going to Micron's valuations, it is currently trading at a 49% discount to its processor and memories average PE of 25 times. So we value Micron at a target price of $500 based on 16.8 times forward PE. So it is still at a discount of 34%. 34% discount to its peers average forward PE. So overall, our investment thesis for Micron is that we do think that high bandwidth memory 4 is expected to ramp from second quarter onwards this year. We do think that it is able to chip away SK Hynix market share in high bandwidth memory because of its better specs. And secondly, we think that because of the severe shortage in memory chips, we do think that the DRAM price will continue to increase, and this will further accelerate revenue growth for Micron itself. And because Micron has a very strong presence in the US itself, we do think that Micron can further benefit from grants as well as tax incentive from the US government. For example, Micron has benefited from $6.4 billion of grants from the CHIPS Act itself over the past few years. So this represents about 8% of their total assets. And we do think that going forward, they are able to receive additional grants because of this strong presence in the US. Yeah, so that's all from me. I'll hand over the time now to Helena. Thanks.
Thank you, Ekman. So I continue with Apple, which released their result last week. So their first quarter revenue and PATMI were within our expectation. The revenue grew 16% year on year, which is their fastest growth in 4 years, which is mainly driven by their very strong demand in iPhone, which grew 23% year on year, and also the rebound of the China market, which grew 38% year on year. Their first quarter revenue and PATMI were at 31 and 34% of our forecast. So what we like about Apple is they're obviously seeing a very strong iPhone 17 cycle. It's an all-time high for the product. Demand is very strong, leaving Apple with very lean channel inventory, and now they have a constrained supply, mainly due to the constrained advanced node 3nm class capacity. And we're seeing the strength of the cycle being very broad-based. We're seeing record upgraders across geographies, and we're also seeing double-digit growth in switchers. That means people switching from other phone brand to iPhone. Apple continues to expect the iPhone line momentum to continue, and they've guided the next quarter revenue growth of 13 to 16% year on year, which is also very high. And so we're seeing this iPhone 17 circle as very durable, especially with their upcoming Siri rollout, which is supported by their recent collaboration with Google Gemini. So this will further reinforce the upgrade narrative and provide additional upside. We forecast for FY26, the iPhone sales growth is going to be about 14% year on year. And the second, which is a pleasant surprise, is the China market rebounded very strong. Their revenue grew 38% year on year, which is especially strong considering that the entire 4 years they've been having very flat or even negative growth. So the iPhone 17 lineup definitely resonated very strongly with the China customers, and they're also seeing a double-digit growth in their in-store traffic. So their in-store traffic is usually very correlated to their product sales. So that shows that the consumers are very interested in their product. We have to point out that this strength is achieved despite their iPhone 17 Air was released later in the quarter, and also their Apple Intelligence is not yet being available in the China market at all. And so the iPhone right now rank among the top 3 smartphones in China during this quarter. And given right now China contributes to around 18% of Apple's total revenue, so definitely a key market for them. So a rebound in the region definitely represent a meaningful upside for Apple. What we're a little bit concerned about is the rising memory prices, so that might pose a margin headwind. Management did know that memory costs had only a minimum impact in the current quarter, but they've cautioned that the effect will be more pronounced in the next quarter and upcoming quarters. But Apple has historically demonstrated very strong cost discipline, and they do have multiple levers to offset the input cost inflation. They've guided the next quarter gross margin to be 48 to 49%, which still implies a 100 to 200 BPS expansion. They say it's supported by favorable product mix and service mix. But we do see that a continued increase in the memory pricing would be a potential risk to the product gross margin, particularly with the elevated iPhone volumes and the ongoing supply chain tightness. So in terms of guidance, they've expected the next quarter revenue to increase 13 to 16% year on year. So this is expected to continue growing at double-digit rate. They're guiding the gross margin, like I mentioned, 48 to 49%. They've also guided the operating expense to be slightly higher as well because they're trying to increase their investment in AI. Overall, we're still cautious on Apple because the stock is still in a prove-it phase, right? They haven't really rolled out anything like they promised, and particularly at a very high valuation of 30x forward PE ratio. We're still cautious. I mean, near-term momentum is definitely supported by the strong iPhone cycle and also their partnership with Gemini, which we think is a very pragmatic AI strategy for them. So it not only accelerated their feature rollout very fast, but it also limited their AI spending and also preserved their ecosystem control. But with that said, with the rising memory costs, and ultimately their ability to sustain a product-led growth and execute a very successful series rollout will be very critical to underpin its current valuation. So we raised our FY26 revenue and PAMI by 2% and 3% respectively to account for the strong iPhone 17 growth. We've also increased our terminal growth rate from 3% to 3.5% to reflect the long-term monetization potential from their collaboration with Gemini, which strengthens their AI capability and supports sustained ecosystem engagement. So overall, we upgrade to a neutral rating with an increased target price of $260. So that's all from me. I'll pass my time to Serena.
Thanks, Helena. Good morning, everyone. I will present Meta fourth quarter 25 results. Yeah. So the earning actually exceeded our expectation with revenue up 24% year on year, and adjusted PATMI actually increased 9% year on year to $22.7 billion. This is driven by robust ad revenue growth. Financial year 25 revenue and PATMI were at 100% and 110% of our financial year 25 forecast. The earning actually pulled out a little bit by Reality Lab because the losses it was $19 billion in financial year 25. So turning into the positive, we still see a very strong AI-led ad performance with the ad revenue actually up 24% year on year, driven by higher user engagement and also strong advertiser demand and the improved ad efficiency. We particularly see a very attractive monetization and engagement opportunity in video, form content, and also threads because Reels watch time is up 30% year on year in the US in this quarter, while at the same time the time spent on threads up 20% year on year because Meta did perform the recommendation upgrades. And also the continued model optimization actually lifted the organic feeds and video views by 7%. This is the largest quarterly revenue impact from Facebook product launched in the past 2 years. So because of this very strong momentum for this business segment, we actually do expect 30% year on year ad revenue growth moving forward. As for the Meta family of app, other revenue, it grew 54% year-on-year. This is supported by a very strong WhatsApp performance, especially in pay messaging and also verified subscription. For example, like WhatsApp click to message ad in the US actually grew like more than 50% year-on-year because they have more adoption by the user, and at the same time, pay messaging continued to scale and currently has a $2 billion annual run rate. Turning to the negative, Reality Lab continued to be unprofitable. The operating losses actually grew 21% year-on-year to $6 billion this quarter. But moving forward, Meta do expect the losses to have peaked this year. It will be similar like financial year 25. And then they do expect they will gradually narrow down the loss-making gap. And for this business segment, the investment will continue to be more focused on variables because on the long-term basis, they actually do want to build a profitable VR ecosystem. And for CapEx guidance, they did provide a guidance for financial year 26. It actually implies an 87% year-on-year CapEx growth if the spending reaches the top end guidance, which is between $150 billion to $135 billion in order to support the core ad business and also, of course, the expansion of the super intelligent lab. Currently, we do think that Meta still demonstrate a very strong ability to monetize the current existing product, and at the same time, because they're expanding a lot of potential pipeline and the momentum is still very strong as well. They still do it in a very effective way in order to grow the advertising ecosystem. So in terms of the revenue growth, for Meta actually guided a revenue for the first quarter of 26 for 53.5 billion to 56.5 billion in the total revenue in the first quarter. This actually implies the highest growth rate in 5 years. So it will be between around like 26 to 34% year-on-year. So Meta, we do maintain an accumulate rating, but we increase our DCF target price to $825. As we currently roll into a new financial year, we increase our financial year 26 revenue and PATMI forecast by 7% and 8% respectively, because we do expect moving forward, the ad business will continue to be benefit as the company is working on integrating LLM with the recommendation model. We think that it will continue to enhance the ad efficiency and pricing. Yeah. Next slide, please. Next slide, please. Yeah. So I will provide some of the updates on 17 Live. So recently, the company actually made some changes in order to boost the live streamer activities. The first one is that it's quite significant, is that they remove the exclusive contract with the streamer so that it could encourage the legacy streamer to return to the platform. So without this exclusive contract, the streamers can actually stream via multiple platforms instead of stick with one particular platform. The company also organized a monthly event, often with a partnership with a commercial brand, because they do realize that it helps to enhance the streamer visibility and also helps to boost the user activity as well. And then to further boost the engagement, the platform also integrate in-app games that helps to prolong the streaming duration, because they do see there's a very strong correlation between time spent and the user spending. And for the live commerce segment, they also try to expand it by creating additional monetization stream, like they integrate branded campaign and product into a streaming event. And the platform also try to leverage the expertise in the event execution, which actually helps to support the small and medium-sized enterprises in Japan to seek overseas exposure. And they are also V-Live expansion effort in order to diversify the group's revenue. The business model currently offer the option for existing live streamer in order to allow them to to have a diversified their own revenue stream as well, because for VLiver, they are more focusing on creativity and character development when it comes to the content. And lastly, we think 17 Live has an IP-led monetization potential, because it currently has its own IP portfolio after the acquisition. And in order to maintain this IP, it's not in very high cost, but it creates multi-layer monetization potential. Let's say, for example, if one IP actually took off, because all the merchandise and so event appearance actually can deliver a higher margin compared to the conventional virtual gift sharing. So for 17 Live, we currently maintain our financial year 25 forecast, and we have a buy rating with an unchanged target price of $0.45. This is to supported by the continued growth in the core streaming segment, which is Liver, and also incremental contribution from the new business initiative, which is VLiver, and the IP portfolio that I mentioned. Yeah, that's all from me. I'll pass the time to Hashim. Thanks very much.
Thanks, Serena. Yeah, I'll be going through a Nordic Group initiation. Thanks. So some background on the business. So Nordic Group started out as a systems integrator focused on the marine as well as petrochemical industry. But since then, they've diversified themselves into a conglomerate with 9 businesses under their wing. Some of the unique businesses that you can see here is Starburst. Starburst is focused in the security industry, so they build shooting ranges, and they also do maintenance of shooting ranges. You also have a Nordic Flow Control, which is their flagship business that does systems integration for vessels. You have NVPL, which is their air and water treatment business that's really focused on the semiconductor industry. And Avon is aviation fuel distribution business that they just recently acquired in 2023. All the other businesses are mainly focused on engineering services, so things like scaffolding, insulation, as well as precision engineering. So in 2024, their revenue was 158 million. Their net margin was about 11%. Their business model, they like to segregate it into maintenance services, which is a higher margin recurring revenue, as well as project services that's dependent on customer capex. So why we like the business? First, we have observed an increase in customer capex across their core markets. So some of the markets include semiconductor. So in Southeast Asia, you might have seen the news where they just invested, Micron just invested 24 billion for a semiconductor facility in Singapore. Apart from that, Nordic Flow Control also has a strong relationship with Chinese shipyards, which is a strong tailwind to their Nordic Flow Control business. In 2025, over 70% of ships built were built from Chinese shipyards, and this is significant for the business because back when China was building up their shipbuilding industry, Nordic was one of the few firms to get into China very early. And so they have very strong relationships with these Chinese yards, which has been a strong tailwind for their Nordic Flow Control business. And apart from that, Starburst, they have a robust pipeline, especially in Singapore and Middle East. And given the geopolitical tensions, we expect more business from Starburst. The second reason, there's improving margins from their maintenance services business. So in a span of 5 years, 2019 onwards, their maintenance services net margins increased from 15% to 20%, whereas their project services business decreased from 10% to 8%. Currently, their order book is majority made up of maintenance services. So about 65% of their order book is made up of maintenance services, which is higher margin. And so we expect this to flow through to their bottom line in the coming years. Last reason, they are becoming net cash in 2026, and we think they are well positioned to do accretive M&A. So early on, their acquisitions such as Multi Heights and Ensure Engineering, these were earnings dilutive because they were trying to diversify their business away from the petrochemical exposure. But now the recent acquisitions such as Starburst has been earnings accretive. So their PE multiple was double digit, whereas the PE multiple of these companies was single digit. So they are essentially buying a dollar of the company's earnings for cheaper. And going forward, we expect any future acquisitions to be earnings accretive. So risk-wise, one of the main risks is the operational risk. Earlier, we saw that their project services had a margin of about 8%. And this is a segment that's prone to cost overruns and delays, and this can eat into their margins. Second risk is their geopolitical risk. US and China makes up about 15% of total revenue. In the past, US imposed tariffs on ships made from China. Although it's currently on a truce, any ongoing or escalation in these geopolitical conflicts can increase risk to Nordic's revenue from these regions. The third risk is that the project services segment is mainly dependent on customer capex cycle. So if there's an industry downturn, for example, in the semiconductor, their MVPL business, for instance, can get affected. And their last risk is their limited float. They have a float of 25%. Management has told us that they would be willing to engage in corporate actions to increase float in the future. So valuation wise, our DCF derived target price is 63 cents. We also sense checked with the PE as well as EV/EBITDA multiples. PE share price, median share price came out to be 72 cents, and the EV/EBITDA median share price came out to be 56 cents. And our DCF derived target price of 63 cents is in the mid range. So we initiate coverage with a buy rating and a target price of 63 cents. So with that, I will pass on to the next speaker.
Yeah, thanks, Hashim. Yeah, let me run through some of the REITs results or business updates. So first of all, we have FCT. So the title is they're back to 99.9% occupancy. Yeah, so that's mainly because if you remember the previous quarter, they had Cathay vacated their assets at their property, or terminated their lease at Causeway Point and Century Square. So now, after first quarter 2026, it has been backfilled. So SCS Cineplex, they backfilled the space at Causeway Point, and GV filled the space at Century Square. So the rents are around similar to previous for GV. SCS Cineplex slightly lower. Yeah. So other than that, the portfolio metrics were stable. Like shopper traffic and tenant sales also remain steady at 1.3% and 2.7%. Their cost of debt was stable at 3.5%. The leverage increased mainly due to the Hougang AI, and we expect the cost of debt to decline further to 3.3%. So this is really a significant decline from the peak of 4.1% last year. Yeah, so for the outlook, basically the Hougang Mall Phase 1 has already completed. So they added 33 new Hougang concepts. So the overall completion of the whole AEI is expected in September 2026. And right now, 80% of the AEI has already been pre-committed, and they are targeting a 7% ROI. So that's a similar target ROI to the AEI that's at Next that's going to commence in the second quarter this year. So the AEI and Next will add another 44,000 square foot of NLA. So they reposition some of the car park space into some retail and office spaces. So which results in the additional NLA. And the estimated capex is 90 million. So this capex will be shared with the JV partner. And going forward for tenant sales, we expect the momentum to continue. So this is supported by the government support measures like the CDC vouchers and the SG60 voucher. So I did some rough calculations. Roughly, we're expecting about 1 billion more from these vouchers to come in this year, as in 1 billion that's yet to be unspent. And population growth and new home completions expanding the catchment population also for the suburban population and rising household income. All these factors will help to support tenant sales growth. Yeah, and to add on, there's limited incoming supply also, so roughly about 1% CAGR through 2028 of the private supply 1%. And occupancy cost 16% is still below historical averages for FCT. FCT's historical average pre-COVID is about 17%. So these factors support a 5% rental escalation or 5% rental revision that we expect for FY26. Yeah, so we upgrade to buy mainly from the recent share price performance. So 5.6% yield, no change to our target price for FCT. So this was just a business update. So no financials were provided. The next slide, please. The next, we move on to Keppel DC REIT. They reported record high DPU. So for their performance, if you take a look, the gross revenue was up 42% year on year for the full year 2025. That's mainly because of acquisitions of the Keppel DC SGP 7 and 8, as well as Tokyo DC 1 and 3 as well. Coupled with the fact that their rental reversions were very high at 45% for FY25, as well as the inbuilt rental escalations. So this was partially offset by divestment of the Center Campus and the Cluster Data Center, as well as the absence of the one-off DXC settlement sum of almost 10 million that was received in 2024. Yeah, they also recorded some lower interest, lower financing costs from lower interest rates, from loan repayments, but the overall rate is the overall finance cost basically will increase because of the new loans taken for acquisitions, and basically the DI is up 35.2%. So that's mainly from the contributions from the acquisitions, but DPU is up 9.8%. That's mainly from the preferential offering. They raised over 160 million, if I remember correctly, off the top of my head, or 180 million new shares. So that really diluted the distributor income again. So now the DPU is up almost 10%. So for the operations, the portfolio occupancy was stable. Rental reversions were strong at 45% for the second quarter because they didn't have any major lease expiring. So the rental reversions for the fourth quarter was at 2%. Usually the very high rental reversions were for Singapore co-location major renewals. So going forward, they do have some of these leases that are up for renewal in 2026. So we expect similar rent reversion. But overall for FY26, we don't think that the rent reversion will be that high, 45%, because that is really very high. So we're expecting perhaps a low double-digit type of rental reversion for FY26. Yeah, and for finance costs for the fourth quarter, it was at 2.8%. So it declined quarter on quarter, basically 10 basis points every quarter from 3.2% in the first half. So now it's at 2.8%. Or rather from 3.1% first quarter, then second quarter 3%, then third quarter 2.9%, now it's 2.8%. So overall their full year 2025 finance cost is at 3%. And going forward, we expect the full year finance cost to inch down to about 2.7%. Yeah, and for them, currently most of their foreign source income, they hedge it till end 2026. So the FX risk is kind of mitigated. And they do have a lot of debt headroom, 530 million debt headroom to the 40% internal cap to pursue accretive acquisitions. Yeah, and for portfolio valuations wise, it was up 3.7% on a year-on-year basis and on the same store basis. And Singapore led the gains at 6% growth. So for the negative for them, the Guangdong data centers, they're still basically they're still under stress. They still didn't receive any payment. Rather, right now they still have over 50 million owed to date in overdue rent from the Guangdong data center. So no improvement there. Yeah, but basically all this has already been factored into the DPU. Yeah, so if they in the future, if they do manage to receive payment, there will be a huge upside to their DPU. And for the outlook, data center demand is still very strong because of AI. So because of rising AI workloads and growth in cloud computing and digitalization. And Keppel DC still continues to look out for third-party acquisitions. So that's in Japan, South Korea, and Europe. And the divestment of the NetCo bonds is expected to complete in the first half of 2026. Yeah, and that will free up capital for redeployment. So that is the NetCo bonds contributes about 11 million of income every year. Yeah, so with that, we upgrade to accumulate the return surprise performance. lower TP. With a forward yield of 4.8%. Next slide, please. So for CapitaLand Ascott Trust or CLAS, basically stable DPU. They've already guided since last year that they will have a 6.1 cents DPU for FY 2025 and FY 2026 as well. So basically this upcoming year, we're expecting 6.1 cents as well as they guided. So for the performance-wise, their gross revenue was up. So that's mainly from stronger operating performance and their portfolio reconstitution initiatives. That they made a lot of acquisitions and divestments throughout the year. And basically, if you exclude that, their gross profit was still 1% higher year on year on the same store basis. So for the first time, CapitaLand Ascott Trust, they are retaining some income. So they retained 23.2 million of income this year. And as a result, the distributable income was 233.5 million, up 1% year on year. If you include the full income available for distribution, it was up 11%. So for the positives, all key markets registered year-on-year growth. So you see the chart at the top right. That is the actual RevPAR growth. You see Japan is down minus 42%. That's because of acquisitions and divestments. Like they acquired one budget hotel, which resulted in a lower RevPAR. But on the same store basis, Japan is up 11%. And the UK is down 2%. That's mainly because of the winding down of the Cavendish London at sort of the end of last year as they prepare for AEI. Like they're going to, the AI is already ongoing. So if you exclude that, the UK property saw a 10% year-on-year increase in RevPAR on a same-store basis. And the RevPAR basically was driven by higher occupancy. So it was up 2 percentage points to 83%. And for the financial position, the borrowing cost remains stable quarter on quarter, and we expect it to remain at these levels for the rest of this year at 2.9%, and gearing is healthy as well. So for the negatives, the PBSA performance similar to last quarter has softened. The rents are slightly lower, occupancy is also slightly lower. That's mainly because of increase in new supply as well as uncertainty over visa policy. But for classes properties, still relatively more resilient as 90% of the tenants are local at the PBSA. So for CLAS right now, they have 5 AI projects in pipeline, 4 are already ongoing. So they've already indicated that they'll use previous divestment gains to top up the loss of income. So currently they have about over 300 million undistributed divestment gains that are still sitting in the books that they can use to top up the DPU. And they continue to explore more creative acquisitions. So they're targeting more in the living sector. So in countries like Japan, UK, and Europe, Australia as well for the living sector. So they have a target to reach 25 to 30% of their AUM in the living sector. Right now it's slightly under 20%. So that is the stable base. And basically for FY26, stable DPU, so 6.1 cents is kind of expected. So we maintain our cumulative call with a target price of $1.08. So considering the 6.1 cents, the FY26 dividend yield will be 6.2%. Next slide, please. So next we move on to our United Hampshire REIT, US REIT, the initiation. So necessity spending underpins this strong 8% dividend yield. So this 8% dividend yield, we think is very attractive in the current market conditions. So just a quick background, United Hampshire REIT is they invest in grocery anchored and necessity-based retail properties, which are also known as strip centers and climate control self-storage facilities. So right now they have 21 of these retail properties and 2 self-storage properties. And you can see the pie chart on top right. 95% of their income is comes from the grocery and necessity properties, which is their strip center, and the self-storage is about 5.4%. So UH REIT, they are sponsored by UOB and the Hampshire companies. So it's a 50-50 joint venture. So both sponsors, they're partnered for a very long time, since 2008, and they have a combined AUM of 1.3 billion across 3 US real estate funds already. So they've been working together for a long time. Yeah, and the geographical composition by AUM, you see the pie chart at the bottom right. So they are mainly on the East Coast. Yeah, next slide, please. Yeah, so for the key investment merits, so first of all, US REIT has a very defensive portfolio. So it's grocery anchored with stable cash flows. So they have a very long WALE, 7.5 years, high occupancy, and 97% for grocery and necessity. If you take a look at the top right hand corner, that is their occupancy for the portfolio since June 2020. The lowest it has been was 94.7%, and right now it's at 97%. And for self-storage also remains relatively high, at 95%. So for them, the underlying strip center, they focus on essential goods and services. So that is more resilient than discretionary retail formats. And their tenant retention is also very high, 90%. And so as coupled with the long WALE, so this will provide really predictable and recurring income. So for their leases, it's structured, most of them are triple net, and they have a built-in rental escalations. So the usual, or rather the normal built-in rental escalations for their portfolio is roughly 1 to 3% for inline tenants every year, rental escalation, and for anchor tenants is 5 to 10% every 5 years or so. Yeah, so that is the inbuilt rental escalations for most of the leases. And for them, they are omni-channel enabled retail format. So for their strip centers, basically it really supports e-commerce. So it serves as a last mile fulfillment and pickup point for online orders and curbside collection. So their properties, their strip centers are at highly accessible locations, so very near residential catchments, so well located, and they're seeing increased footfall across all their strip centers. So that is a plus as well. And for the capital management, their leverage is healthy, so at 39%. So they have about over 80 million of that headroom to pursue more higher cap rate grocery and necessity assets. So the grocery and necessity assets have a cap rate of about 7.5%. So that is higher compared to the self-storage. So that will give them a good positive carry. So they are looking to acquire more assets in this retail. And right, they also will benefit from lower interest rates. So basically 21.5% of their loans are on floating SOFR SOFR rate. So they'll benefit from interest rate cuts, and they do not have any refinancing requirements until February 2028. So quite very strong balance sheet. And the table at the right in the middle shows their top 10 tenants. So a lot of them are household names like grocery, Walmart, LA Fitness and such. And their WALE for top 10 tenants is very long. So within the next 3 years, rather by end 2020, from now to 2027, they have less than 10% of leases that are up for renewal. Yeah, next slide, please. Yeah, so some of the risks for UH REIT, they are highly dependent on grocery strip centers, grocery anchor strip centers, like I mentioned, 95% of their income is from there. So they are sensitive to changes in consumer spending habits or e-commerce trends or any major tenant closures as well. And right now, the top 10 tenants contribute 51% of rental income. So any loss of a major tenant could impact their revenue. And operations-wise, their self-storage properties are managed by third party. So that will also impact or their performance if they do not manage it well. And for currency, you can have basically unit holders have the option to receive the distributions either in USD, SGD, or through distribution reinvestment plan. So basically, you can mitigate that currency risk in SGD terms if you elect for distributions in USD or DRP, and as well as, of course, a regulatory or taxation risk or to changes in any regulations or tax treatment that could potentially impact UH REIT's distributable income as well. Yeah, next slide, please. Yeah, so with that, our valuations, we initiate with a buy coverage target price of 69 cents. We use a DDM cost of equity of 8.35%, 2% terminal growth rate. So our forecast, we priced in a 96% distribution payout ratio for this year as well as next year. So it's a 7.9% FY25 yield dividend yield and 8.5% FY26 yield. They're also trading at a discount to NAV of about 0.26% discount to NAV. Yeah, so you look at the table at the bottom, that's a peer comparison table. For them, they do not have any listed peers, direct listed peers, as they are quite unique, as they are the only REIT that's focused on US grocery centers, strip centers. While other listed REITs in Singapore, like as you know, focus on retail, like they do not have any grocery anchor strip centers in the US. So if you just make a comparison like retail for retail, UH REIT is trading at a steeper discount to NAV as compared to the Singapore retail players like FCT and CICT and such. And UH REIT is also trading at a higher dividend yield as compared to these retail players. And if we compare UH REIT to the other US listed, Singapore listed US REITs in Singapore, like the office REITs, basically UH REIT is performing way better than them. Their yield, UH REIT is paying 8% yield, while the other three REITs are still basically Manulife and Keppel Pacific Oak have not paid any dividends, but prime dividend yield of 2-3%. Yeah, so UH REIT is more attractive if you compare it to that. But of course, they are in different subsectors. One is in the three are in office, while UH REIT is in retail, so it's not really a good comparison as well. Yep. So that's all for UH REIT. I hand over time now to Zain for the technicals. Thanks.
Yeah,
oh, sorry.
thanks, Darren.
Yeah, thanks.
Morning, everyone. So yeah, I'll be covering Ziyi for Phillip Macro update on FOMC last week. Yeah, so in terms of the outcome, it was as expected. The Fed maintained rate at 3.5 to 3.75%. In terms of the vote, it was 10-2. The dissenters were governors Micron as well as Border. In terms of the whole key points, the OL actually mentioned that there was reduced tension between the dual mandates, and also labor market is showing stabilization after a gradual softening that we saw. And in terms of the outlook, I think she said that the Fed is likely to keep rates on hold, and with limited urgency for further easing until first half of this year. And rate cuts are expected to resume only around mid-year, broadly in line with market pricing. Next slide. Yeah, I'll move on to technicals. Next slide. Yeah, so first one, looking at S&P 500 last week, we saw that the price actually faced some resistance from the retest of this short-term trend line breakdown. That's in this black trend line over here. And yeah, so I think this week wise, we're likely to still see some continued sideways consolidation with quite a lot of resistance at the 7,000 level. And support, in terms of near-term support, that should be the 50 SMA level, which is a green moving average you see in the chart. And at the lower end will be the 100 SMA, the blue line. So overall, I think resistance likely to be at 6,965 to 7,050, while support is likely to hold at 6,825 to 6,900. Next slide. So next one, looking at the Hang Seng Index, I think we saw there was a breakout in terms of the range consolidation. So we think that uptrend is likely to resume for the Hang Seng Index. So looking in terms of the chart, there was a sideways consolidation since end of September, and then price actually, in terms of the price action since start of this year, there's been some positive price action where price actually broke above the 26,136 level, horizontal resistance, and held as support afterwards, and we see price continue to form higher lows along the upward support line as well, coupled with increasing momentum in MACD. So with that, there was a breakout last week. I think we are likely to see price actually gradually head towards the potential target level at 29,198. So that's if you take the height of this range, projected onto the breakout level at 27,188. Next slide. Yeah, so with that, we have a technical buy for the iShares Hang Seng Index ETF, code 3115 at $98.62, take profit level at $105.50, stop loss at $94.50, and the last close on Friday was $99.70. Yeah, so the chart actually looks similar as the Hang Seng Index. Next slide. So we also have about ETF monthly for January. So our title is we expect a bullish February for the S&P 500, oil, Singapore equities, and Hang Seng Index. In terms of how the different various asset classes perform in January, most were in the green. The outliers were US Treasury bonds, which had a slight decline of 0.2%, and Bitcoin was the top loser, down 4.6%. In terms of the standout performers, I think it would be gold as well as oil. So gold was up 12.4%. Even after the decline we saw at the end of the month, oil was up 11%. In terms of the current trends, S&P 500, gold, and Singapore equities are in an uptrend. Some of them are in range consolidation, that being the US Treasuries, oil, as well as Hang Seng Index, and Bitcoin is in a downtrend. So for outlook for February, we expect the bullish February for the four asset classes mentioned earlier, and sideways consolidation likely to continue for US Treasury bonds, while gold and Bitcoin are likely to see some pullback this month. Next slide. Yeah, so first out, looking at the chart of the S&P 500 ETF VOO. So overall, I think the uptrend is still intact as it's trading within this uptrend channel itself in blue since July of last year, and mainly kind of sideways consolidation we've seen in January. So if you can break above the 642 resistance level, then I think we could see the uptrend continue, probably towards $650 next year. And next slide. Next one for the 7 to 10 year Treasury bond ETF, IEF. So some slight weakness, but I think likely to maintain a range consolidation. So in January, price broke below this rising wedge support trend line level. However, it's still maintaining the more important $95.50 to $97 range consolidation. So I think we're still likely to see some sideways movement this month. Next slide. Next one for the Gold Mini Shares Trust, GLDM. So yeah, after a very strong rally, we saw some profit taking. So I think this month we're likely to see some pullback, perhaps to retest this upward support line as well as the previous horizontal resistance level closer to about $92. Yeah, so we could see some pullback after this strong rally this month. Next slide. Next one for the oil and gas exploration and production ETF, I think there's still possibly more upside to come. So the code for this XOP. So in terms of the chart, there's been a nice ascending triangle consolidation at the resistance at $130.30. So price has been moving sideways since September last year. That's about a 4-month consolidation. And I think there's a breakout at the end of the month. So I think we're likely to see this price actually going higher to actually possibly retest the $155.50 level. So that's a swing high back in March 2024, and also confirm the target level if you take the height of the ascending triangle project down the breakout level. So in terms of the chart, it looks like a fresh breakout for the XOP. Next slide. Next one for Bitcoin strategy ETF BITO. Overall, the downtrend is likely to continue. So in terms of the chart, at the end of the month, there was a breakdown below this bearish flag support. And so we are likely to see this downtrend continuation continue to actually potentially retest some of the previous support levels from end of 2024 as well as in March, April 2025 last year. So that could that's around like $10.25 to about $11.18 level. Next slide. Yeah, next one for Singapore equity ETF. Overall, it's still very bullish. So there's in terms of January, we saw an acceleration in terms of bullish momentum. So previously, price was rather steady in this uptrend channel since August of last year, but start of January this year, once it broke above this $4.75 levels, price really just accelerated upwards. And we think that the upside will continue this month towards about $5.30 next. Yeah. Next slide. Next one for Hang Seng China Enterprises Index ETF 2828. Overall, still rather a bit of a sideways consolidation, but I think overall still positive. Price is still trending in a very gradual and more volatile upwards movement in this rising wedge. So as long as it holds the $91 and whether it can break above $98.50 about there, then I think we can see some uptrend continuation this month to potentially hit about $106. That will be the target level if you take the height of the range projected and to the breakout level at $98.50. Yeah. Next slide. Yeah, so that's all for the ETF monthly. Then in terms of our technical calls initiated last week, these are the progress. So for the buy for the Hang Seng Index ETF is currently in progress. It's up about 1.1% as of Friday's close. Then buy for Singtel is in progress as well. Currently flat as of Friday's close. So that's all for the technicals. I'll hand over time to Paul for the weekly. Thanks.
Yeah, thanks. Next slide. Oh yeah, these are some of the key macro highlights for last week. I think in general, what we do, the one to take note of is probably industrial production in Singapore, which is basically manufacturing. You can see a big jump in electronics, driven by semiconductors. And then for Singapore, US also, there's a huge jump in capital imports. But I know we'll get back to that later. Next slide. So in terms of technical views, just a recap of what happened in January. So January, the market was up about 5.6% for Singapore. This is a record 9 consecutive months of gains. Over that 9 months, I mean, the market up almost 30% or 28%. In terms of the economy, so Singapore economy remains very vibrant. I think the fourth quarter industrial production is up almost 20%, which is the best since 2017. And I think what's bringing up manufacturing activity in Singapore is like semiconductors and even hard disk drive. So for the two sectors that we still like, semiconductors, I think like we mentioned a few weeks ago, TSMC significantly increased their capex over the next 3 years. So equipment makers like ASML is beginning to feel it. So their bookings in the most recent results a few days ago, they mentioned that their bookings jumped to almost doubled to 13 billion year on year, and this is like a record number. So this is positive for Franken, especially. I think because Franken, ASML is one of their largest customer. The timing of it is a bit unclear because you still need to get the fabs completed, then you need to put in the equipment. But I think the outlook for Franken is positive because the bookings is there, and you're probably going to go back to that the huge demand and the huge huge undersupply of the ASML lithography machines. And for Franken, the benefit for them is they're doing the higher end products, and they also benefit from more outsourcing to Asia. Of course, we cannot compare valuations between ASML and different animal, but anyway, for ASML, they are trading about 50 times, I think. Franken is probably teens, but of course, these are two different companies. ASML has the IP, of course. The other thing that is positive because construction, I think BCA raised their demand for 2026 by 50 billion. Year on year is almost flat in terms of new construction orders. But speaking to some contractors last week, I think there's going to be that massive Terminal 5 order. So there are 3 phases to Terminal 5, I think totaling almost 20 billion. Some of it will be awarded this year, and then the rest probably next year. Then, of course, we got hospitals like Tengah Hospitals. We have, of course, the massive HDB BTOs, Marina Bay Sands, the third tower, and then Harbourfront 2 billion development. Apart from the usual like LTA, MRT. So the issue right now is not about orders, it's about whether the industry can cope with the capacity, whether they have enough capacity to cope with all the demand. Now, in terms of the market, we have a chart later, but anyway, the market is now trading about 16 times forward, Singapore market, against the 25-year average of 15 times. We think there is room for valuation expansion because interest rates are low, only 1.16% if you 3-month SORA, and of course you got EQDP flows that will shrink which will provide a liquidity premium finally for domestic stocks. And also we got earnings growth, which we'll mention later. So if you take a 1 standard deviation about 19 times, you're looking about 5,007 for the index, which is about 15% gain. These are some of the key events, Palantir, Alphabet results coming up together with Keppel, SGX, Amazon, for your reference. We have some our webinars coming out. A lot of REITs coming up, and it's open to anyone who wants to listen in. I think on the 4th, we have two Keppel companies, two Keppel REITs. Next slide. So I'll move on to, as usual, every beginning of the month, we'll just have a recap of what happened in January. So in January, the big gainer was, if you look here on the left, is property and construction, largely property. What you see on the table here is some of the small mid-cap gainers and losers. Then at the bottom is the index gainers and losers. So you will notice at the bottom, top SPDR gainers, a lot of it is property like UOL, Hong Kong Land, CDIL. Yeah, Gokko Land also at the top 25%. Yeah, so property was the big winner for January. Next slide. If you move in by asset class, Singapore outperformed the US, especially once you add in another 1+% of the strength in the Sing dollar, compared to the S&P up about 1.4. But the real winner for last month in terms of asset classes was commodities. Of course, gold was up 12, but the big ones were gas. If you look at the commodity ETF, the big one was gas up about 18%, then crude oil about 17. So again, this is just for your reference. Next slide. If you move on to by asset classes, the big gainers was, I think, semicon continued to rally. I mean, this drives up Korea and Taiwan. Weakness was Indonesia and of course, and also India. This is the 1 month performance in local currency terms. Next slide. All these are in our monthly report anyway. This is the by index. All the banks enjoyed gains. The big one was UOB, but all the three banks enjoyed gains in January. In terms of the top right, property was the huge outperformer, the best performing index performer. Of course, the property that we mentioned. The weakest was some of the yachts, Yangzijiang shipbuilding, and of course Seatrium. So the yachts were the ones that were the weakest. REITs are still soft. I mean, they were underperformed, maybe 1-2% in improvement in January. Next slide. In terms of our model portfolio, again, this is just for reference, for illustration, it was up almost 9%. The one that helped the performance was semiconductors, Franken, and construction, which is Wehe, and then city development also up 16%. And of course, the banks also helped the performance. Next slide. Okay, next slide. So this is just a recap of our monthly, Singapore monthly. We have monthly strategy, weekly strategy, and hopefully next time no daily strategy. Okay, but just to recap the performance again, and then the outlook. So for us, we do see the US economy still resilient and Singapore vibrant. So if you look at GDP now, which tracks the US GDP almost weekly and has quite a good track record, the GDP is tracking about 5% growth quarter on quarter. So this is the best since 2023. So then in Singapore, manufacturing is doing well. It's probably the best since almost 3 years performance. And again, this a jump in electronics about 25%. Then in Singapore, domestically, loans growth is also strong, supported by buoyant consumer loans. We've not seen this type of loans growth for many years. And like we highlighted before, once loans growth is good, then it kind of leverages up the economy and then kind of boosts economic growth. In terms of the recommendations, we remain positive on the market valuations, and we think, like we mentioned before, valuation can expand. And in terms of the earnings growth for the Singapore market, I think we think the CapEx cycle will be the one that will boost earnings growth. We see that in semiconductors, renewables, AI, and of course construction. This CapEx cycle is not just in Singapore. We also see that in the US. We'll show you a chart later. Next slide. So this GDP now number, so they're trading about 5% quarter-on-quarter growth for US. So no issue with the growth in the US. Everything is resilient. The one on the right is the CapEx, just a gauge of what's driving the US economy. If you look at the red line, this is CapEx goods imported. So technology imports, I'm talking about computers, telco equipment. December, it was up almost 40%. In over 3 months, about 33%. So the AI spending is really driving the US economy too. Next slide. If you move on, nothing much is just what we mentioned. And the one on the right is the construction contracts awarded. So if you notice, the uh the highest in the past was about 38 billion. Right now we are trending at 50 billion per year. And the visibility is even up to 2030, I mean, based on PCA forecast. Next slide. This is just the line here you see is just the forward PE of the index. And then if you look at the current PE is now 16 times. So if you take one standard deviation, which is the red line, about 18.6, this is all mathematics. Doesn't mean you will hit or will not hit. But anyway, because since everyone like to ask about index target, if you look at 5,007, then you're looking about 15% upside. That's how you read the table at the top there. Yeah. Next slide. Okay, this is my last slide. Again, this is not going to benefit us as an investor, but I mean, since if you want to figure out, so as you know, the MAS, when they talk about monetary policy, they will the default option or for the MAS is always to maintain the appreciation of the NEER. So NEER, just think of it like a Singapore dollar against the basket of other currencies like China, Malaysia, those countries that we trade with. So they will either change the slope, change the width, which they hardly do, or they will do recenter upwards. That means like gap up the currency, which is normally very aggressive. So the last three meetings is all about maintaining the appreciation. So what this generally means is that Singapore dollar will appreciate roughly 1.5% per annum against a basket of currencies. Against the US dollar is, I don't know, it swings up and down, but anyway, this is just for your reference. It's not going to help you in making stock picks, but this is just for information. Next slide. I think this is the last one.
Sorry, I'm just showing this because somebody in the Q&A section was requesting for this. I think we can start the Q&A section.
Yipman or someone, can someone start?
Yeah, hi, sorry. Let me just take on the few questions. Which Micron peers are you referring to? Yeah, so in terms of our peer comparables, we compare to the high-end processor companies like NVIDIA, AMD, Broadcom, Intel, Qualcomm, and memory peers are SK Hynix and Samsung. Yeah, so if you purely compare it to SK Hynix and Samsung, Micron is still trading at a premium. I do believe that this is because Micron is ultimately in the US markets. It has more liquidity compared to SK Hynix and Samsung, which are trading in the Korean markets. Yeah, so but if you compare Micron to its US peers, processor peers, which are the NVIDIA, AMD, Broadcom, etc., Micron is trading at a steep discount. Yeah. Is SK Hynix and other competitors coming up with better quality chips and with higher specs versus Micron? Yeah, so currently the visibility we have is high bandwidth 4. So this is the fourth version. That one we expect it to ramp in the first quarter of this year onwards. SK Hynix is the earliest to ramp, followed up by Micron. In terms of better quality chips in the future, the next version will be HBM4E, which is the enhanced version of HBM4. That one is expected to ramp next year onwards. But that one we don't really have visibility in terms of the specs yet. So that one we do have to keep a close lookout for the specs when the company release. Yeah. Thanks. Any takeaways from Seagate, ASML, SanDisk, Western Digital? So for ASML wise, their earnings is accelerating. Is revenue-wise, it's up 10% compared to previous quarter, 4%. And their bookings has also gone up significantly by 80+%, as what Paul mentioned just now. So we are seeing a lot of demand directionally in terms of high-end equipment for high-end semiconductor equipment from foundries. And they also mentioned that Intel has also purchased their first they have recognized revenue from the 5200 equipment, which refers to the high-end EUV machine from ASML. So I think Intel is also trying to double down on their foundry business. So I think that's the main takeaway we can have from ASML's results. For the remaining results, I haven't taken a look at those. Yeah. So if I have any insights, I'll share. Thanks. Yeah, okay. I think that's all from my end. I'll hand over the time to my other colleagues. Thanks.
Okay, let me take on some. What is Keppel DC going to do about Guangdong data center letting overdue rents accumulate? Yeah, so they've already let this overdue rents accumulate for over 2 years already by now. So the amount is over 50 million. So for now, they're still waiting to see if there could be any improvement in the operations. Like a silver lining or positive was that recently China approved the import of Nvidia's H200 chip, so that might help. Hopefully, we do not see any more asset devaluations as well for China. I think this valuation cycle we saw Chinese property saw like if I remember 16% decline in valuations because of the poor operations. Hopefully we do not see anymore, but generally for them they will still keep or rather maintain the tenants there and do not kick them out. So yeah, that's what they've already guided. So and also in our estimations and forecasts, we've already forecasted zero income contribution from that asset. Yeah, so a lot of it has already been priced in. Where the question jumped? Give me a second. Yeah, so if they do receive payment eventually of this 50 million, that will be a huge plus to their DPU, a huge potential increase in their DPU. Yeah, but for now they'll still let it accumulate. For United Hampshire REIT, the rental escalation per lease agreement is not on an annual basis, but only when lease expiry comes. How bad will this affect dividend payout? Yeah, so for inline tenants, their rental escalation is on a yearly basis actually. So it's like 1 to 3% every year. It's only for the anchor tenants that the lease so-called the lease as the rental escalation is every 5 years, 5 to 10 years. So let's say if the lease term is long, like over 10 years, then in the middle of the lease, let's say every 5, like at the 5th year, they will have a rental escalation. Yeah, but other than that, generally the higher rents will come from the rental reversions, as you know. Yeah, but for United Hampshire REIT, the portfolio is very defensive and resilient. So and the WALE is so long, so we do expect the distributions to be very stable. So not much growth there, but we are getting a high yield of 8%. So that's our take. Yeah. So how would that affect dividend payout? Yeah, we've already factored that in, and we are looking at above 8% yield. So we think it's attractive going forward. What's the REIT segment preference order for 2026? Yeah, so for us, we still prefer retail. We think the RTS kind of the headwinds that everyone's worried about, we think that is overblown because of a few reasons. So kind of let me just explain why. So one of it is the RTS the capacity off the top of my head is I can't remember the exact numbers, just slipped my mind. But basically the KTM current train, they have about 1,000 capacity that will come offline as well. So it's not just a plus for the RTS. So that is one. And with Singaporeans spending a lot currently in JB, so there's also inflation in JB that a lot of the people living in JB are complaining about. So the prices in JB are increasing while the prices in Singapore, in comparison to Singapore, you're not getting that much value as compared to investing in, or rather, not investing as compared to buying your groceries in Singapore because of the increasing price as well as the exchange rate. And with the RTS also, it's not just a one-way thing where there's leakage of sales to JB. Like with the RTS, we are expecting a lot of Malaysians to work in Singapore as well, so that will help with the F&B industries. Of course, we don't expect these Malaysians to come and shop in Singapore, but definitely they will help with the F&B. So it's not just a pure sales leakage to JB. And in addition, if you want to do grocery shopping or whatnot, most of the time you'll be driving in. I don't think you want to carry your rice and fish and chicken across the border. So I don't think that is a huge impact. But maybe some sectors that are affected, probably the services, electronic sector. Yeah, but definitely but we think the leakage will be very minimal, and there are still a lot of tailwinds that are supporting retail sales, like CDC vouchers, population growth, higher international visitor arrivals also. Tourism receipts are increasing, so all these are supporting retail sales. So we think the rental returns potential is still high, so that's for retail. Office and industrial, we expect kind of mid-single digit generally. For office, limited incoming supply, especially in the core CBD region. Industrial rents definitely softened since COVID era. So for prime logistics, we are expecting probably a mid-single digit kind of rent reversion. Supply is mostly in the single user, the factories. And then hospitality. So hospitality, this year, first quarter, possibly strong because of the Singapore Air Show. But going forward, this year, the other big one out, I think you can think of the BTS at year end. So other than that, I don't, off the top of my head, I don't think there are many significant events that can really drive the improvement in international visitor arrivals like that we saw in 2024. Those numbers were like Taylor Swift, Coldplay, Ed Sheeran in just one quarter. That one was huge, very high base. So yeah, going forward, we do still expect higher international visitor arrivals and low single digit RevPAR growth. So I think that will be our least preferred. Hospitality will be our least preferred segment. Yeah, I think there's still a lot of questions. Let me type in. I'll leave the time to some of my colleagues.
Yeah, okay. Let me just try that. Anyone can interrupt me, if you all have any. Let me try to answer the main one. Everyone's asking about the Singtel. Have you earlier target price estimate plus already factored in today's news about KKR acquisition, ST Telemedia? Okay, so some were also asking whether this deal. So we think this deal is almost confirmed, and I think this deal should include Singtel. I think there are some questions whether Singtel will be included. Just remember the shareholder of ST Telemedia is Mr. T. Shareholder of Singtel also Mr. T. So I think they will definitely. I'm not talking about the A team, Mr. T. I think you know who I'm talking about. But anyway, so I think this deal will likely, Mr. T will likely want Singtel to be involved in this deal. And I think my guess is Singtel will probably want to take an associate stake because they don't want to take on the debt, and their focus would be their focus would be on the Asia part of the data centers. Maybe the associate can be as much as 30 to 40%, and they want to have the Asia Pac data center because Singtel also has their own Asia Pac footprint of data centers, and then they could always merge it together and go and list it one day, or rather soon. When rather than because GDC's data centers all over the world, from Japan to Europe and so forth. But I think they are only interested in the Asia Pac, probably ASEAN preferably, and then they can list it together. They can combine and then list it. I think that will get better value because if you list a data center all over the world, neither here neither there, then you become like entity. Or shouldn't say that, the entity REIT. So you're going to get a bit of discount if you have data centers all over the world. So I think their focus is just to focus on maybe ASEAN preferably. I think then you can get better valuation premium. That's my view anyway. Yeah, for what it's worth. Yeah. Okay. The other question a lot of people ask is any view on Kevin Walsh news impact on the US market and this? I really didn't. Again, everyone has their own view, but I didn't really think much of this because he's technically a hawk, but I don't think Trump. His comments has always been about being a hawk. He doesn't even believe in quantitative easing, but I don't think Trump will elect him if he doesn't cut rates. So, my view is he will come in and then he will just cut one rate or two rate cuts, then hold back a bit. Then yeah. So I think better to see what he does rather than all the views because he's supposed to be a hawk rather than anything else. Singtel announcement. Sorry. The other question is Singtel announcement. The buy on data center. Any impact? Good news or bad news? I think it's definitely going to be a good news. I think Singtel will structure it so that it will be earnings accretive. Okay. Okay. So sorry. Let me just try. There are some questions on software stocks. So apologies. I think Fahmi is not in. I think because Malaysia is on Malaysia is having it's a holiday, so I think we probably can't help you on that. Okay, this is a different type of question. Paul and team, would company where people associated with Epstein files be affected? I don't think so. I think yeah. Unless you're talking about Tesla, then if it's a company where it revolves around a single individual, then maybe. But apart from that, I don't think the impact will be there. Because yeah. What's the view on all tech stock? So we are still positive on all tech stock. I think they are trying the share price weak because the share price had done so well, and also there's not been much news. I think they are trying to work. I think their focus is to get a recurrent income stream from some as a feedstock plant to SAF. So I think such deals will take time. But we are still positive on the company. Yeah. There's a lot of Microsoft and Oracle. So sorry, Fahmi's not around. Why is Pacific Radiance underperforming Nam Chong and Marco Polo? Is it a buy or weakness or still? We no change in our target. Just that there's been a bit of change in the senior management. The previous CEO has left, so we will need to update you again on the changes. So yeah, apologies for that. Yeah. Collywood news this morning. Good between Collywood and Assembly Place, which is the better buy? Okay, so Collywood and Assembly Place, they are both in co-living. So think of co-living, for those who may not know, between a hotel and a rented apartment in Singapore. And some people don't want to have a rented home because you have to stick with 2-year lease. You have to put in your own amenities, utilities. Yeah, and so people like to stay in co-living. So it's between yeah. For me, I prefer Collywood because Collywood really owns the assets. They have the balance sheet and they take the effort to own the assets so they can get a better gain on it. Because by owning the assets, putting in a Collywood franchise, you actually raise the valuations and then you also what you call it, you placate yourself or you ensure yourself that your landlord don't keep increasing the rents. So asset light is good, but when your landlord see you doing well, especially if it's a residential housing, which Assembly Place focus a lot on, I mean the landlord not going to let you get away with you enjoying, especially you just got listed, right? Enjoying such nice rental income. So you're always subject to the risk of your landlord squeezing you. I mean, like a better word, but Hollywood kind of, I guess, kind of placate that or hedge that by owning the assets. Of course, it's painful in the near term because when you buy an asset, you have to spend time renovating. And then and the other strength of Hollywood is that they do a lot of renovation. So they buy a property. The example we used to give is the Frasers property in Orchard. Used to be 70 over plus service apartments. Because of their renovation and their ability to save space optimization, it became a 400 key 400 key co-living building from 72 service apartment. Don't ask me how they carve and cut it out, but that's their strength also, the renovation part. Okay, how much will this stake in STT GDC contribute to normal? I don't think there'll be much impact on the dividends. I think, yeah. And I don't think they're going to do an equity raise. They might raise the leverage. And if you're a Temasek company, I mean, why not leverage up, right? I mean, people are not going to penalize you because because you have such strong parentage. Why not make use of it? Okay, let me leave the rest to Darren or Glenn or if got any other Oh, okay, let me answer this last one. Hi Paul, this morning news of ST set up National Space Agency. Is ST Engineering a beneficiary? I really not clear because ST Engineering, in a way, you can see they just exited the space business by not doing satellite and so forth. But you know, ST Engineering is the defense arm of Singapore. So if there's anything being developed there, they will be the one beneficiary. But I'm not sure. Space was never mentioned before in any of the discussions before. Yeah. Hi Paul, any further insights on the 25% jump in electronics? We think a lot of it is semiconductors and also hard disk drive that we mentioned. Okay, I think a lot of the questions I tried to type it out. What's your view on the successor to Fed chair? Is he hawkish? He's supposed to be a hawkish person, but then when he put in the chair, I think at least the next few months he has to be dovish. Otherwise he's going to get attacked by Trump again. Okay, I think I'll leave it to the rest. If not, we'll give Darren for sorry, Zane. Zane, you want to go ahead?
Okay, I'll take on the few questions. Yeah. Give me a moment, I share my screen. Okay, so the first one on Penn United. Yeah, for Penn United, I think there's a bit of a breakdown in terms of the short-term momentum recently, where price is below this 119 level, as well as you can see price especially on Friday, it broke below this some of this short-term movement, which is the 5, 10, 20 SMAs. So I think with that, we're likely to see some weakness, I think, to retest this around this 112 level. So which was this key horizontal level over here. Then in terms of short-term resistance, I think will be around about 116, 117 about there. So we could see some maybe sideways movement for now first. Next one for CapitaLand investment, I think overall the uptrend still remains very strong. So it looks like it's doing a sideways. Looks like a possible bullish flat consolidation overall. So I think as long as it holds the 10 SMA currently around $3.04, as well as this horizontal level, I think we could still see the uptrend continue with the next key resistance being around like 320. So overall, it's still intact as long as this short-term momentum doesn't break down. Next one is 3988 Hong Kong, which is Bank of China. So for Bank of China, I think the chart is still positive. Overall, if I zoom out, it's still a uptrend, and it's been looks like a breakout of this consolidation at 465, and price has been making higher lows along the way. Recently, also positive movement where price is back above this 452 level, this key horizontal level after consolidation. So I think all in all positive signs for this breakout, and I think we could likely to see this uptrend continue. With target level perhaps around target level maybe around like closer to 530 about there. So if you take the height of this ascending triangle and project onto like 465. Next questions. Okay. Next one is on Sembcorp Industries. So for Sembcorp Industries, I think overall still rather sideways movement. You can still see the key resistance still at 613 to 620 this area. Okay, then range support still holding around 596. So I think it's still nothing much, quite range bound. Yeah. They will likely stay support at 596 and lower end is 580s. For weaker, I think some weakening in terms of the short-term bullish momentum. Price-based resistance around 92.5 cents, and then last week broke below this 90 cent 5 and 10 SME level. So we might see some pullback to test this swing low over here. That's around 85 to 86 cents area. Then we might see some bounce and I think some consolidation for now. With short-term resistance, I think likely to be 89 cents for now. Yeah, so I think the price action looks a bit similar to last year, this part. So after the breakout of this consolidation, then there was a bit of pullback and kind of just sideways movement. So we might be seeing something similar over here. Next one for Keppel DC REIT, I think some pickup in terms of the price recently. So it was range bound between 220 to 227. Then I think there was a increased volume as on Friday, and today managed to sustain above 226. So I think still positive. Short term wise, I think might still move. We might still see some further rebound towards the short term resistance around 232 to 234 area. So this was like a previous support breakdown in November last year. So yeah, I think for Keppel DC might see some continued rebound. Next one, Yangzijiang Maritime. Yeah, for Yangzijiang Maritime, I think in terms of the chart, still a bit of a downtrend and a bit sideways for now, I think. So price booked below this 60.5 cents level with some increased volume recently, and I think we might see another retest of this 57 cents to 58 cents support level again. Then might do some sideways movement with resistance probably around like 59.5 cents to 60 cents or there. The next one is on HST, which is the Hang Seng Tech ETF. So for this, I think there's some signs of weakness. I think, so with a breakdown of this 91 cents level, so this was after multiple retests, as well as lower highs over here. So increased volume as well. So back to this support area, like 87 cents to 88 cents. I think we might still see some weakness overall in terms of the short-term trends to perhaps go lower a bit to 86 cents or 85 to 86 cents next. Yeah. Next question is on Palantir. So I think for Palantir, it has price has pulled back quite a bit over, especially the past three trading sessions. So I think is back to this support region again. So that's around 142 to 149 area. So I think price might do a short-term rebound after such a bearish move recently. So I think we might see some rebound over here, but we'll face some resistance from about 155 to 158. So I think could be something similar to over here, start of January. So when price came down quite a bit, then we see a dead cat bounce afterwards and come sideways. Next one is our LAU. I think not sure which counter is it referring to. Maybe you can clarify in the Q&A. Then I go back again. Yeah, thanks. I'll move on to the others first. S59. SI Engineering. So I think that for SI Engineering, there's likely to be further weakness. So there's looks like a breakdown of these head and shoulders, with the neckline at 338. So with that, I think we could see some downside, further downside towards maybe 318 about here as the next key previous resistance level that could act as a short-term support. One is HQU, which is oil tech. So for oil tech, I think overall the trend still downtrend for now. In terms of the short-term price movements, I think broke down this flag formation over here on Friday. So with that, I think we could see some. I think overall we'll still see some weakness. Yeah, to actually test about. Currently is at one support level, which is around 66 cents to 68 cents over here. There might be some rebound, but I think overall it's still quite weak. Resistance probably around 69 cents above. And I think in the near term wise, we could still see price continue downtrend to retest like 62.5 cents swing low again, or the next level around 61 cents previously. Next one for Singtel. I think overall Singtel chart, I think looks positive. So that after a pullback since November, price action wise, we've seen multiple retests of this key $4.55 level over here. And price held this low at 439 over here. Then there was a breakout of this 455 and currently testing 471, this swing high level. So short term wise, there might be some resistance over here, but I expect price to find support around 460. Then afterwards, if it can break above 471, I think we could see a retest of this 484. And yeah, so overall, Singtel I think looks positive after the breakout of this bullish flag pullback and some of the price action movements recently. Okay, then there's a question on Keppel. Yeah, for Keppel, I think overall the uptrend is still intact. So overall, it's still within this uptrend channel itself. Price has been gradually moving up steadily. So for now, I think in terms of the short-term price movement, some slight weakness where price below the 10 SMA. But for overall trend, I think still okay. The support level near-term wise 1069 about there. I think it's still likely to hold. And some resistance is at the recent highs, close to $11 about there. So we might see some sideways movement for now. But overall, the uptrend is still intact. Okay, let me see what's the next question. Any technical outlook for add value tech? Okay, so for add value, I think overall it's still an uptrend. Recently has been in a bit of a sideways, a bullish flag consolidation. So I think still okay for now. Tested the recent 0.074 a few times. And in terms of the I think in terms of weekly chart, as long as it doesn't break below the 10 MA, that will be key. So that is currently 0.066. Like throughout this uptrend, price has been holding the weekly 10 SMA as support. So I think that will be the important level to look at. Yeah, for now, likely just sideways movement with supports 0.067 and 0.064. Okay, then some more names like DBS. For DBS, I think overall still still very good. For now, just some sideways movement. Still higher highs and seeing higher lows. Support I think will be around this $58.80 level, which was like a horizontal resistance start of this year. So I think we'll likely find some support around here and perhaps just continue a bit of a sideways that we are seeing right now. Yeah, in terms of Bollinger Band, also kind of suggests a sideways movement with the upper band just coming down a bit. Next one for Propnex. Yeah, Propnex, I think currently doing a bit of a sideways movement. So it's facing resistance at 223 was a breakdown of this head and shoulders formation and just moving sideways. So I think we'll just do some range consolidation, mainly between 207 to 223 over here right now. Next one is CATL. CATL, I think for now, I think still some price weakness and we need to still facing resistance from this key downwards resistance line. In terms of horizontal levels, is also at this 495 breakdown level, still holding as resistance today. So I think for price to see some rebound, we need to see price break above this 495 and hold there with these two resistance levels recently. So for now, I would still think for still kind of a sideways movement, perhaps between 463 to 495 over here. Then support level for in between is around 478. Next question on Oracle. Yeah, for Oracle, I think overall still downtrend. Short term wise, hit this downtrend channel support at 161. So if it holds, we might see some rebound, but overall, I think will still be very weak. Resistance probably around 170 about there. In terms of lower support levels, if this breaks, I think the next level to look at will be around 150, 151 to about 153 level. Okay, next question on Centurion. Yeah, for Centurion, I think overall, for now, it might do a bit of a sideways. Okay, yeah, because some reason that 155, which was this horizontal level support in terms of resistance, then currently the support is already at 145 for now. So I think will just be a bit of a sideways movement for now. Then if 145 can hold, I think overall there might be still a chance for further rebound. Next one on SPL Lifestyle. Yeah, for SPL Lifestyle, I think currently we're seeing some pullback after the rally. I think in terms of the short-term levels, I think we could see some support around closer to 25 cents. So that will be this breakout level as well as the 20 SMA level. In terms of resistance short-term wise, around 28 cents. So I think for short-term wise now, probably some kind of sideways movement over here within this area. Okay, then there's a question on Geo Energy. Yeah, for Geo Energy, I think, let me take. Yeah, overall, I think still in a bit of a kind of a pullback still continues since October, a bit sideways recently. Now it's at for the 42 cents support level again. But yeah, I think overall might still be quite weak. Support and resistance for now maybe around 43 cents. Be 42 cents breaks below that, we could see revisit around close to this 40 cents swing low again. So it could be still a bit of a range bound, range bound movement within this pullback. Okay, next one is on micro mechanics. So for this, I think overall is still within an uptrend, a quite volatile one. Okay, recently some price rebound on volume, high volume to retest this support breakdown was like 170. So I think for now here might have some resistance. Support wise, in the short term might be around 160, 166 around here. So we might do some sideways movement, I feel. Okay, then if you can break over 170, as well as this downwards resistance line, then we might see some further rebound for micro mechanics towards like close to 175, 176, this level area next. Okay, then next one, Hong Leong Asia, I think we're still in a strong still in a strong momentum right now. So overall, for now we might see some kind of a sideways movement. Support level is around like 323. This horizontal level as well as the 5 SMA. So we might see some kind of a sideways consolidation. It looks like some slight pullback after hitting 350. Next one is on Prime US REIT. So for Prime US REIT, I think so it's back. I think after the break of this 21 cents level, so it's looking better with increased company with increased volume as well. So we might go back to this region of 23 cents to 24 cents again. Then it might do sideways again afterwards. For next one, SafeMac. Yeah, for SafeMac, I think overall the uptrend is still intact. We're seeing this breakout of this 137 resistance holding as support, and overall is an uptrend as well. So I think for now the key will be in terms of the momentum wise, 137 is important to hold for the short term momentum to continue, which is around the 5 and 10 SMEs level as well. So short term wise, I would feel that it might do a bit of a range consolidation with some resistance still holding 144. Then here is and now it's around the close to the support area. I'll take about two more since about close to one. Venture Corp. For venture, I think overall still an uptrend for now. Short term wise, some weakness after breakdown this range consolidation. So I think price might be coming back to this support area again, close to 1580 to 1590 this area. Then you might do a bit of a rebound over here. With resistance probably around 1620 in the short term. Okay, then the last one I'll do Riverstone. Yeah, for Riverstone, I think the price has been falling quite a lot on high volume as well. So in terms of the next support level will be around 71 to 72 cents area over here. Yeah, in terms of the RSI, it's quite 17.7. So it's quite I think quite oversold. Should be haven't seen this value since quite a long time, since 2022. September 2022. So back then there was a bit of a rebound over here. So I think over here there was a bit of a rebound and sideways movement afterwards. So we might be seeing something like that. Yeah. So that's for Riverstone. Okay, I think I will end over here. There's still quite a lot of TA questions, but sorry, unable to answer all of them. But feel free that tonight there's a 8:15 there's a TA webinar. So if you are free, feel free to dial in and you can feel free to ask questions over there. Yeah, I'll hand over time back to maybe Paul if any more comments. Thanks.
Yeah, thanks everyone for your time. I think we got some questions on Oracle. I guess my own view is Oracle probably not trading on results or even the fundamentals, a way to short OpenAI, because I think if there's pessimism on OpenAI, people just use Oracle as a proxy. But anyway, thanks everyone for your time and especially your questions. Apologize, there's still a lot of questions we couldn't answer, but in view of time, thank you for your questions and your time, and wish everyone have